everyone. This is Calvin Russell, CEO and founder of 850 Club Credit. Hope everyone's doing well today. Today, we're going to talk about how co-signing for an auto loan affects your mortgage approval. All right, let's go straight into it. I know we've been kind of talking about auto loans a little bit, but it's actually a phenomenal topic because a lot of people, their buying power, their pre-approval is really calculated based on their DTI, as we know, their debt to income. Now, some things we don't think about is those moments where we actually co-sign for someone, whether we meant to or not. Obviously, the relationship plays a role. For some people, it's an old relationship or something they feel like they shouldn't have done or whatever. And that's usually the typical situation. But the good news is, regardless of the relationship with the person, there's ways where you can actually keep that amount from going against you in your debt to income. I'll give you an example. Let's say, for example, you make a certain amount of money and you don't have a car note. However, you actually co-sign for someone. And of course, that's going to affect your DTI. That's going to increase your debt, which is going to reduce your buying power. So just by co-signing for someone, it's a chance that it's going to reduce your buying power. So how do you get around that? Well, number one, they have to see who is actually paying on the car note. Okay. So for example, let's say you co-sign for your friend. Okay. And if you can show proof that your friend is making the car payments, within a 12-month time frame. And to do that, they can either do a bank statement or they can do a bank ledger. A bank ledger is going to show specifically that creditor over the last whatever period that you choose. And some banks allow you to do this online, actually, so you don't even have to stop in. But obviously, this is something you can't do because this is something that, the person you co-sign for, the co-applicant, this is something that we need to show proof that they have been paying on time. So for the last 12 months, they would need to show, let's say, for example, it's Capital One. They just have to show that they've been making payments consecutively for 12 months to Capital One. Now, what if they've been late? That doesn't really matter. You just need to show that they can, obviously, that they've been making payments on time. Now, obviously, if they've been late, that may be affecting your score and you may not necessarily qualify for a mortgage, but depending on where your scores are, you should be fine. Either way, that's the case there. It's going to be 12 months and you'll be able to show that they've been making those payments. Okay. Now, that's assuming that you're going with an FHA loan. If you're going, that's FHA and VA, by the way. If you're going conventional, you don't necessarily have to show that amount of time. Some lenders will just take, a letter of explanation, or they may just ask for, usually just a written letter just to show proof and a stroke of a signature. It's usually going to be that way if you are going conventional. So with FHA, you just have to show proof that, of course, that other person is making those payments. All right. So hopefully this video was helpful. Of course, if you're looking to start the process of going into home ownership and such, we have a course that you can actually learn more about that. And that's going to be our home buying course. That's a part of our 850 Club Elite as well. Of course, if you're local, then we would be more than happy to help you guys. We got a lot of great things well on the way because we see a lot of these situations and we want to make sure everyone has the right information so you can set the right expectations because the only other alternative, let's say, for example, if you are making those payments instead of that other person, then of course it's going to look like you're just making those payments and it would be difficult to show proof that someone else is making them because you're making them and it's coming from your account. Okay. Now, let's say, for example, you co-sign for, let's say, your son or your daughter or child, whatever the case may be. And, you guys share accounts, right? But as long as they can see that they are having some money go in and that they are having money go out to show a consecutive, 12 months consistently making those payments on time, then that should work as well. Okay. Again, this is what works for most lenders. But if you go to a lender and you run into some issues, guys, just try another lender or have a conversation first before having them run your credit all the time. Okay. Remember that you can always do that. All right. So if you like this video, like it, you want to share it. And as always, be sure to subscribe as we have nothing but great content on the way. Thank you guys so much. Have a great day.